Hi, Mike Swanson here. I'm going to give you a really quick technical overview of the stock market and talk about a couple other things. But this is a chart of the S&P 500 uh, from 2009, the bottom in March to today. And as you know, the market made new highs for the rally yesterday. Although today it's poised to gap down on the opening. And what happened this year with me and my service is in January, I told people to look for a correction. I actually got out of my positions and just sat on the sidelines. Then in February, on the very day the market bottomed, I'll show you how I identified the bottom in a second. I bought back in and told people, now's the time to buy stocks. I recommended some stocks to my premium members, and of course, the market's been going up since then. Although I've personally taken profits because I don't think this move is just going to go crazy. I think the market now, in fact, is overbought. This is the RSI indicator, and it's above 70, a level it hasn't reached uh, since August, and really only reaches once or twice a year when the market gets very overbought. Now, I don't think that means the market's going to collapse or we're headed for a new bear market, but I just think the risk to reward now no longer really favors taking big positions on the long side. Instead, you should wait for another dip back down or some consolidation first. Although, to tell you the truth, I don't really think we're headed for a drop like we saw in January and February, not until the market reaches the April earnings season, which is really about 2 weeks from now. But regardless, just at the moment, I think we're at a very overbought condition, and now's the time to evaluate stocks that you may own that are lagging your portfolio, holding things back for you that you're not interested in anymore, and look to sell them, raise some cash for some better opportunities that should come in the coming weeks. Um, Now, one reason I'm not terribly bearish on the stock market right now is that the selling pressure in the market is just about vanished. And what you see here is the ratio. These are buy orders, these are sell orders on the New York Stock Exchange. And you can divide the two together and come up with ratios. And this green line here is the selling pressure on the New York Stock Exchange. This pink line is the buying pressure. As you can see, since the February bottom, selling pressure is just about vanished. Buying pressure has picked up a little bit, but it hasn't been extreme, and that's because the volume in the stock market hasn't really expanded or done anything spectacular. It's really just been a little thin, I guess you could say. Now that's not a reason to get overly bearish in the stock market too. I know that's an argument a lot of people have been making, is that there's not a whole lot of volume in the stock market, and the volume needs to increase to make this uh, stock market rally continue or to be healthy for the market. But the problem with that kind of thinking is that those people are comparing the volume now to the volume in 2008 and 2009 when the stock market was crashing. And that's record volume that we won't see again, for who knows when. It could be 10 years, 20 years, I don't know. That was a really extreme outlier event, and it's not going to happen again, not anytime soon, and not anytime soon as the volume can expand like that. So don't expect really wild volume in comparison to what we saw a year ago. It's just not going to happen. Another reason not to get overly bearish in the stock market is this is the advanced decline line for the NASDAQ, and it's going up, meaning more stocks are advancing than declining, confirming the strength of the rally. And if you recall, back in January, we were seeing a divergence in that advanced decline line. And that was leading me to say, hey, watch out. We're going to get a good 10% correction, maybe even more than that. And that was why I switched to the bear camp, over the correction camp in January. And since then, the advanced decline line has made new highs, confirming the market rally. Now, on the price point, pattern. Again, we're very overbought. It doesn't make sense to me to get overly bullish in the market and take a whole bunch of positions right now. This is a time I think it's best to take profits, raise cash, have some cash on hand to take advantage of a pullback or, some things lining up down the road. But because, these indicators are still showing strength, it's not time to get overly bearish in the market or be looking. There's no sign that we're, reaching a new bear market or a new bear market's going to begin. I don't see it. And I want you to know that. And one last comment I want to make is another argument people are making that we're reaching a new bear market or to be worried about the stock market is that for the past, since the summer of last year, more money's been going out of U.S. stock mutual funds than going in. Investors have been cashing out in droves. In February, for instance, investors poured $3.7 billion out of U.S. mutual funds, while at the same time, according to Morningstar, they've been putting money into bond funds. To me, that tells me two things. It's not a reason to get overly bearish on the stock market again, because this has been going on since the summer. And what this tells me is that all this inflow volume isn't coming from the average investor. It's not coming from the regular person. It's coming from professionals. The regular Joe, in my view, has not been a driver of the stock market since the bear market of 2000 to 2003. They've been knocked out. This has been a market dominated by professionals. The other thing it tells me is that there's some really, to me, quite bizarre behavior going on. The idea that it's time to be putting money into taxable bond funds makes absolutely no sense to me at all. A couple days ago, I decided I was going to look to see if I could find some good bonds to buy. And I did a search with my brokerage, my broker, and they discovered they were looking for 5-year bond funds, and all they could find were like AIG, some of these big banks that are really still terrible, and all they could get is like 5% interest. And these are like the AA rated bonds. They're pitiful bonds. You don't want to buy them, and you can only get 4 or 5% interest in them. So there's no, it makes no sense to me to buy bonds when they're not paying anything. But yet, the average investor, it seems, is pouring money into bonds and taking them out of stocks, which makes no sense. So anyway, I want to give you a quick overview of the market, what I see going on right now, what I'm looking at right now, and what I think we should be doing and thinking about. So I'll be talking to you later.